Hello and welcome to Big Deal, your weekly dose of all the deal action. I'm Nisha Poddar. Let's first take you through all the top headlines of this week.
Vedanta tries to sweeten its merger with Kane India for the minority shareholders, offer 4 preferential shares along with a Vedanta share for every share of Kane India, minority investors to vote in September. SAJJAN Jindal's JSW Energy announces acquisition of Jsw-Jaypee Group's Bina power assets for 2,700 crore rupees, taking its power capacity to over 6,000 megawatts, half of which is by way of acquisitions in the last 1 year. It's all about India for Brookfield Asset Management. The Canadian firm plans to invest $1 billion into Indian distressed assets through a joint venture with State Bank of India. Masayoshi Son's SoftBank gets all set to buy Britain's most valuable technology company Arm for $32 billion in cash. Oreo cookie maker Mondelez International Inc. offers to pay £200 million for the license to make Cadbury biscuits from UK-based biscuit maker Burton's. It's raining IPOs on the Lal Street. ICICI's life insurance arm Prudential Life files the draft prospectus. Meanwhile, Advanced Enzyme Technologies makes a stellar debut, while L&T Infotech fails to impress.
All right, today on the show, we will discuss the IPO boom in the market. And gentlemen, joining me in this discussion are RAMESH of KOTAK Investment Banking and NILESH of ENVISION Capital. But that's going to be in just a short while from now. But first to the big deal of this week. This week, SAJJAN Jindal is the star deal maker with several acquisitions made in his power company, JSW Energy. In the latest, JSW Energy has bought Bina power assets of Jsw-Jaypee Group for 2,700 crore rupees. Now, with this, now the company has doubled the capacity to over 6,000 megawatts per annum by way of inorganic expansion. Now, I caught up with Sanjay Sagar of JSW Energy to gauge their hunger for more acquisitions.
At the moment, we are looking at about 8 to 10 assets, but there are a lot more assets on offer than just 8 to 10.
So since the supply is more and the demand or the buyers are lesser, do you think that you have that valuation working in your favor?
You see, what we've been trying to do is that we evaluate an asset in a manner that we are assured of a normative return on what we invest. And so far, we've done the acquisitions at those levels.
Why did you have to withdraw from Monet Power?
Well, in case of Monet Power, we had offered a deal to the bankers. And that deal ultimately was not acceptable to them. And because of that, we withdrew.
The lenders are also very concerned about bilateral agreements between companies without going through a competitive process, bid process.
Well, the lenders are concerned only in cases where there is a write-off on the debt component. In case of both the Jsw-Jaypee deals that we've done, we are taking over the existing debts of the company. You
are going to look for more acquisitions. How much more money are you going to put in, and what's your target for the expansion of capacity?
Well, we've sort of set ourselves a target of approximately 10,000 megawatts because, at this moment there are a lot of opportunities available to us, and we are in a position to sort of acquire assets.
With Jsw-Jaypee, you have worked very closely. You bought hydropower units, you bought just Bina, you just closed. Now, there is Vishnu Prayag transmission lines. They are also on offer, and you are in talks for that as well?
Well, as I told you, I'm in talks for 8 to 10 assets across the country. So it's very difficult for me to specify assets.
The amount of money that you are ready to really let go for these acquisitions?
Today we are sitting at a debt-equity ratio of about 1:1.35. We've given ourselves an internal target of 1:2.5.
All right. And what is it that you can do better with the assets which are debt-laden and which are ailing right now, which the earlier promoters have not managed?
The assets which are coming to us are not sick assets. It is because of the overall stress on the group, that they are having to sell their family jewels, so to say.
So jewels are what you're picking up at the expense
At the moment, yes.
Are renewables also on your radar?
Not at the moment.
Why?
Well, there are 2 reasons primarily. The recent projects, the tariffs to my mind are unviable. And in the earlier projects where the tariffs are higher, there's a large dependence on government subsidy. Well, at the moment it will be inclined towards the coal-based projects because there are not very many hydros on offer.
In this financial year, are more deals expected to be announced from JSW?
That's very difficult to say, because deals take time. They are complicated matters. For example, Bina, we signed an MOU almost 8-9 months back.
Is it very difficult to convert deals?
Unfortunately, yes. That is the way.
What is the issue that is happening?
That is the way things work, It takes, as I said, the existing promoters are selling family jewels. It's not very easy for them to take that call and sort of agree to part with the asset which is dear to their hearts.
Of course, so you're confirming to the fact that beyond money and the technicalities, of course, emotions also play a huge role in...
They certainly do. They certainly do, especially in promoter-driven companies, they certainly do.
All right, now it's time for what's piping hot on Big Deal. After 6 long years, capital market is buzzing with IPOs once again. Almost 10,000 crore rupees have already been raised this year by companies making a debut on stock exchanges. Many more big ones are in the pipeline, it seems. And is there enough demand? And what could happen next in the primary market? Let's find out from our experts who have seen many such cycles in the market and will help us crystal gaze with their expertise. Nilesh, Ramesh, welcome to CNBC TV 18. First to the banker who's going to make a lot of revenues because of these deals. Ramesh, we've seen many IPOs being announced. Some of the big ones are going to be ICICI Prudential as well as Vodafone. Do you see that more needle-moving IPOs will be there in the market? Otherwise, the ticket size has been very small.
Most of the IPOs that we have completed and what we see in the pipeline of the market, IPO sizes between 500 to 1200 crore. There will be those 1 or 2 odd exceptions of larger size, but effectively most of the companies are likely to do fundraising and dilution around these kind of sizes.
Okay.
And that is the trend to see. They are around the consumption theme, around BFSI and healthcare. This is the predominance of the companies that we see from these 3 sectors.
So, on that, Nilesh, are you impressed enough with the kind of issuances that we have seen? Are you going to loosen your purse strings?
For an investor, it's very important to kind of really evaluate and take a hard look at these IPOs because they may be the present opportunities, but they could also be the future opportunities. And therefore, I think it's very important to take them more objectively and more constructively.
All right. So, Nilesh, in this particular round, has it been better than the IPO boom that we had seen last time in 2010? And what is the difference? And have you been able to see that they have left something on the table for the investors?
I think, first of all, the number of issuances is much more. I think in a way, the spread or the breadth of offerings is significantly more versus 2010. I think if you look at 2010, the only significant IPO was Coal India, which ended up doing well for the first 1 year, and then after that, honestly, couldn't kind of take that forward. Kind of switch over to 2015, 2016. You're seeing a lot of IPOs from different kinds of sectors.
Yes.
Choice has been very, very broad, and I think that's very heartening to note. So I think that's one. 2 is, yes, I think most of these IPOs have happened at very expensive valuations.
Okay, you think that?
Yeah, there's no doubt about it. They have come in at 30, 40, 50, 60p multiples. In a lot of the cases, it's been the private equity funds which have come in and done an offer for sale and all of that. But if you really also benchmark them versus their peers in the secondary market or the listed space, then they're not too expensive. On a standalone basis, they look expensive. But if you really benchmark them, because the common thread running across most of these companies is they're fast-growing companies, they're high-growing companies, they're very capital efficient, they throw cash flows, they have virtually no debt. Promoters with skin in the game, they're passionate about these businesses, they are leaders, these are names you can reckon with and relate to. So I think these are some of the good qualities which are there, and therefore you have to pay a price for buying quality.
Coming on this one, Ramesh, of course, an investor is saying that the valuations have been expensive. And that's what we've been talking about, that the promoters, the bankers have not been leaving much on the table for the investors. And especially in the last 2 rounds, I have personally also observed that. What do you have to say in your defense?
So there is a fundamental shift to a little higher valuation. So it's all around the consumption themes, around healthcare, around the BFSI space. the nature of some of these companies are absolute valuations high.
Yes.
But they do leave IPOs by their very nature have that IPO discount. And I actually would like to submit to you that investors are pushing back companies on valuation. So leave the absolute valuation. But today, investors are discerning. They are pushing back investors on IPO valuation. And that's why, in some ways, these listings are happening well.
But also, don't you think, because the ticket size is lower, it's making all the difference?
After a long time, I'm seeing on day one of an issue, retail is oversubscribed. Institutional investors are coming in day one of an IPO.
Yes.
So some of these trends we have not observed before, but we have started to see them in the last 1 or 2 issues. So there is excess momentum. And if you look and if you correlate that to inflows, which we saw last year and this year a little different. Last year was significant domestic inflows.
Yes.
So mutual funds and insurance companies virtually had 20 billion of inflows. The FII inflow was muted. It was close to 3 billion. This year, in the first 6 months of the calendar year, FII inflow is already at 3 billion. But the domestic funds are a little muted in the equity markets. I don't think IPO sizes are driving this. I think it's what exactly Nilesh said. It's nature of these companies and the profile of these companies, which is making investors to take these bets.
So some quality companies have come in the market, Nilesh. You'll agree to that?
Well, yeah, I think each one of these companies, I think they're fantastic companies. You can relate to them. They're leaders. Some of them really dominate a niche and all of that. And I think the big difference, and I'll allude to our discussion earlier, that the big difference, I think, is this time is that in 2010, these companies were capital seekers. They went to the market to seek capital. Okay, I think this time around, everybody is not seeking capital. Okay, there's either an exit for a private equity guy, or basically these companies want to list for better visibility, to attract talent and all of that. So to that extent, these are really the capital efficient guys, and I think that's a very, very big difference, and I think the market is responding to that by the kind of overwhelming response which these IPOs are getting.
That brings me to one worry, that then probably corporate investments have still not taken off because the money which is coming in is only for exits and not really for expansion and more operations. Is that one of the things?
When you look at markets like the US, you never really hear about power generation companies going public and port companies going public and all of that. These are more M&A plays. Private equity guys come in and there's control transactions, buyout, infrastructure lenders come in and all of that. But you really don't see here a lot of IPOs there. Okay, which used to be the case for India.
Yes.
Perhaps, who knows, India is going in that direction. Where it's only the capital efficient guys who come in and kind of IPO themselves. The rest of them have to resort to the debt market or any of the other structured transaction marketplace.
All right, but anyways, fundraising overall is not that high in especially commodity and the capital intensive sectors. The markets are very selective, the investors are very selective. So there is, we'll take a short break and we'll talk more about that. So there is enough euphoria and exuberance in the IPO market. Is this unnerving or will this sustain? We'll find out in the next segment. Stay tuned to Big Deal.